Well, hey there, everyone. Dave Keller here with Market Misbehavior, and welcome to this Friday mailbag episode of Chart This with Dave Keller. I'm your host, Dave Keller. Actually, not in Redmond, Washington. We are on vacay. I got the family in Iceland. We recorded this ahead of time to give you a little Friday mailbag action today on Friday, August 21st. Hope you guys are all doing well. Hope you are having a great week, and hope that the answers to these questions make you think a little bit. As a reminder, every day when we live stream our market recap show, and we will be back in the week after next with the new live market recap show for sure. But between now and then, every time we do a live stream, we take questions during the live stream, but also you are always welcome to put questions on our YouTube channel and just use the comment section there. So all these questions came from before we went on vacay. We had a bunch of great questions in the mailbag and thought, why don't we do a couple mailbag episodes while we're gone and just give us some things to think about. I have found it's always a good time to make some meaningful improvements, even some little incremental improvements in our investment process. And I hope this helps you do so. So please keep the great questions coming. And let's get to question number one. Question number one is awesome because I've actually had just recently had some comments, some discussion with my premium members about this particular question. The question is the fear and greed index broken? And I appreciate so much the question that you're asking. So there are a number of different kind of fear and greed indexes, to be honest with you. I guess that there are different ones you could be referring to. One that comes to mind that I'm showing here is the CNN Fear and Greed Index. This is combined by a number of different things. If you look here, and again, it always helps to look underneath the hood and see what's actually included. So this one, which gets a decent amount of airtime, the S&P and its 125-day moving average, which would not be my choice to use, but whatever, it's something. New 52-week highs and lows has not been particularly strong, so that makes sense. We look at the new highs and lows data, the breadth, so it's looking at the McClellan summation index. Put call ratio has been okay. Volatility, I don't know about neutral, like it's pretty low. Safe haven demand, junk bond demand. This is where like credit spreads have become fairly narrow. So this one is actually currently in greed around 60. Now, I don't look at the fear and greed index very, very often. So I guess your question is it broken? So a lot of these different, there are a number of composite indicators, like Bank of America has another one that's widely followed that I used to follow closely in my Fidelity days. I probably prefer that one a little bit just because I know the inputs a little bit better. But a lot of these have a combination of trend, breadth, and sentiment, right? Or sort of like the three main, and then maybe like positioning. But you probably include that in sentiment, and those are kind of the main things that are used. And so at this particular point, if you think about the trend is pretty overwhelmingly positive. So anything that's more momentum based with the S&P at or near new all-time highs is going to be pretty good. The breadth conditions have generally been very strong, as we've seen, although one of the factors there was the new highs, new lows data, which is more neutral. But most of the breadth indicators that we talk about on the show are generally bullish at this point. Again, sort of mid-August. As we're recording this, the sentiment one is honestly, depending on what you look at, is pretty bullish to overwhelmingly bullish. And the one that is usually included, which you saw there, were credit spreads or high yield spreads. And those are very, very narrow. Volatility is very low. So for a lot of those indexes, we're very much on the greed, like almost moving, aggressively on the greed side. Because of the positive trend, the positive breadth, and the positive, basically the very low credit spreads, right? The bond market's not giving a lot of signs of concern. So is it broken? I mean, so no, what I would say, in my opinion, like those indexes are not as good of timing tools, at least in my experience. I think of them as more anecdotal evidence. And I guess I would bucket something like the fear and greed index or something like the B of A bull bear indicator is the one that I was thinking about, which recently was just at its highest level since like 2001, I think. I think of those kind of like the Hindenburg Omen, which we've talked about a lot of times on the show. The Hindenburg Omen is not as much. I don't think of it as much as a timing indicator, but it's more of of sort of market conditions indicator, I guess. And then based on when you see this thing, firing a signal, just like when you see the bull and bear indicators get really, really bullish, I don't think that necessarily means today's the day you want to be selling. At least for me, it's not. It's more, all right, we're showing similar conditions to previous market tops. Now let me actively look for a potential breakdown to confirm or to validate that extreme bullishness that we've seen. So I guess that was a long-winded answer of saying, is the fear and greed index broken? Like, I don't think so. I mean, but it's just, what is its value, I guess, is what I would think about. And I don't think of things like the Hindenburg Omen as a timing indicator. I wouldn't create a fund or a portfolio strategy built around the Hindenburg Omen. But for me, it's become an important way, or with these bull bear indicators, it's sort of a really valuable way of recognizing a certain set of market conditions that just make you realize, okay, we are now so overextended and so bullish that these indicators that have previously signaled a lot of tops are firing right now. We were more likely sort of in the later innings of this rally phase, and now I want to look for signs of deterioration to reflect the fact that that warning siren was well founded. Because that's how I would think about it. I'm curious if there are any particular, I mean, I'm assuming you're talking about like the CNN Fear and Greed Index, but if there's a different one or one in particular that any of you have found quite valuable, I'd love to know. Drop a comment and let me know. Always interested in taking a look. But the one that I followed the most was the B of A Fear and Greed bull bear indicator, and the Steve Leupold's group had they called it the Power Trend Index, I want to say, and that was like 60 different factors. It was pretty interesting, but helpful. Again, not a timing tool, but more of an illustration of a certain set of market conditions and telling me to start being a little more wary. I think that is actually what they're all doing for the most part right about now. Next question. Do you prefer using the same moving average periods across multiple time frames, or do you adjust them? For example, using a 50 and 200 day moving average on daily charts and then a 10 to 40 week on the weekly charts. So absolutely, yes. I would adjust them and pretty much in the way you described. For me, and I'll show you what I do. I'm a big fan of setting up chart templates. For me, that's super valuable. On stock charts, it's these little quick buttons called chart styles on the left, but most good charting platforms have the ability to set up like a template so you can like bring up different time frames and things like that. I find that super valuable. For me, the daily chart has the 21-day exponential moving average and then the 50 and 200-day simple moving averages. And then when I go on the weekly, basically the 200-day moving average becomes a 40-week moving average. And it's not the same, but it's pretty close. I mean, it's a pretty close approximation. And then I bring in a 150-week moving averages as like a much longer term average. So I'm a fan of kind of scaling them. But then like on the monthly one, I've just become accustomed to having the 12-month and the 60-month, which is basically a 1 year and a 5 year moving average. But again, on the monthly chart, I'm not using that for like timing or much. It's more just to take the noise out and appreciate more of the long-term trend characteristics. But I go back and forth between the daily and weekly very frequently. And I think, being thoughtful about which moving averages you need on which chart is more helpful. The 50-week moving average and the 200-week moving average for me, not as helpful. And I found other settings that make sense. Having said that, I see other people that more just switch the time frame and don't think that much about it. Okay. For me, I like the consistency, and actually, I wish I did better at this. But what I actually do, I mean, if you think about it, so for me, right, if you look at these different moving averages, the 21-day EMA is in green, the 50-day is in blue, the 200-day is in red, and then when we go to the weekly, the 40-week is in red too. Right. So the 40-week and 200-day are the same color. The purple is the 150-week. So that's a different color. So I actually try to make the colors consistent. That's a trick that I learned from John Kosar of Asbury Research. He does a really good job of, if I remember, I think, John, that was you that had something like that, but had different timeframes with different moving averages and color coded them so you could kind of see where they're at. And I've tried to extend that in other parts of my process too. So I have a market trend model, and it uses these this color coding, and I've experimented with other time frame settings that use other coloration to try to link them around. That actually, I mean, that whole idea of using different colors for the different moving averages and stuff really comes from, I would argue, from Edward Tufte. There's a really cool book by Edward Tufte called Beautiful Evidence. It's a great like coffee table book, but it's really, he was and is an expert in data visualization, not financial data, although he did do a little bit of that, but it was more just design and elegant data, and having the data, the visual representation of the data being very, very important. And when I was at Fidelity and worked as part of the chart room team, ran the chart room, it was required that everyone that worked in our department did the 1-day Ed Tufte course and learned directly from him, because he just had a lot of great insights on labels and colors and shapes and just how to make the chart be very visually rich but also meaningful, and getting rid of like the crap that doesn't really tell you anything, get it off the page, and just having everything be intentional. And I learned a lot from that experience. So that was a long-winded way of saying, yeah, I'm a fan of using consistent moving averages across different periods. At the end of the day, the right answer for you is whatever's going to help you understand and appreciate those timeframes. And if that means different moving averages, you should do that. All right, next question. This came from last week, where we had the inflation data. We had the CPI and PPI coming out. So the question is, the CPI and PPI were exactly as forecast. That's fair. I mean, they were slightly different, but pretty much in line with expectations. This leads me to think that it may really mean that supply and demand are in balance. I'm thinking this may forecast a slowing demand and economic cycle. So interesting idea. So what you're basically saying is like the CPI data was kind of in line with forecast, and it wasn't better, it wasn't outperform, it wasn't better than expected, right? It wasn't like it was any better. So, does that mean supply and demand are really in balance? And if there's not, and you had a longer question I summarized here, if there's not a lot of inflation, what does that mean? So honestly, I mean, remember, it's not like there was no inflation. There still is some. It was just the pace was not as extreme. And I would say with things like CPI and PPI, it's less about what the data shows, and it's more about what the market expects. And it's really not even what the actual number was. It's more the actual number relative to expectations, because the market prices in a particular outcome, right? And with economic data, you have to remember that the market is pricing in a particular inflationary, reality. And so if the reports kind of come in much higher or much lower than expected, that's when, the market was pricing in something different. So, I guess the reality is, when you're looking at the chart of the S&P 500, I mean, why is the market making new all-time highs? Given the fact that there is still a conflict in the Middle East with an uncertain outcome, right? Which arguably in some ways maybe should put more pressure on different things. I mean, I guess is one like sort of way to think about this. And the fact that the inflation data is coming in more in line with expectations means no, right? I mean, and crude oil prices aren't as high as you might think. So the economic impact of the conflict in the Middle East probably less than some would have expected. Certainly less than I expected, given the scale of what's going on and the uncertainty about it. So I would say the fact that the data came in line with expectations basically means that's not the thing that's going to derail this current market environment, right? And I guess the way I would also think about it is, when you have a market in an uptrend like this, I'm always thinking, what's going to derail this, right? What is going to cause this beautiful uptrend we've been observing, this fantastic breakout in the beginning of August? What's going to cause it to implode and cause the bull market to be over? And a couple things, like obvious ideas, come to mind, right? Number one, like inflationary pressures, right? The conflict in the Middle East either is sustained to the point that we start to question how long that we can go without prices going higher. We just start to expect higher inflation as a result, or things start to escalate and we just assume that higher inflation is going to come. But like some sort of events in the Middle East and inflation are like certainly one thing that could derail things. rates going significantly higher, which could be tied to that first one, but could be different, right? Maybe it's related to the Fed and expectations about rate hikes, but expectations change, and all of a sudden, investors feel like, maybe the Fed has to start hiking rates sooner, and then as a result, the market starts to risk assets sell off. Could be earnings, right? Could be we start to get earnings that shows that things are not as good in the technology space and the retail space, and people say, this week, for example, and I don't know because this is going to come out later, but it's a lot of big box retailers, right? What if all the big box retailer earnings talk about a slowing economy and inflationary pressures, and all of a sudden it's like, oh my gosh, that is a huge issue again. So there are a number of things that could derail it. And I guess the fact that the inflation data came in where it did just tells me that's not the thing that's probably going to derail the markets now, right? We'll see what happens next month and in the month after, right? In updated data. But all that basically says is that's kind of temporarily off the table as a downside. As a downside catalyst, I guess is how I would think about it. Does that imply like slowing demand and a slowing economic cycle? I mean, not necessarily, right? I mean, because I would say, again, when you think about the overall picture, particularly from earnings, I mean, it's still very robust and very strong. So we'll see. So those are some thoughts, I guess, that I would think about it. And I would also say, always remember with things like CPI and PPI, they're always right? They're looking back. They're not looking forward. It's not an estimate of future inflation. It's reporting on inflation that kind of already happened. The markets are looking for those. So one of the challenges with economic data is it's always a rear-facing evaluation of how the economy was a little bit ago, and the stock market is forecasting in the future. So I would say if expectations about inflation change, we might actually see that in stock prices rolling over first. And remember, the market often sells off before there's a meaningful economic slowdown, right? So don't look at the economy for signals as to what the stock market might do. We want to look at the stock market for indications about what the economy might do. So those are a bunch of random thoughts, and sorry that was a long-winded and all-over answer, but that's it. All right, we're going to continue on in a minute. Just a quick shout-out to one of our partners, Seeking Alpha. They have a new product called the Quant Growth and Income product. They have a quant team run by Steve Kress. I've interviewed him a couple times on the Market Misbehavior podcast. They just released this new product, which really uses their quant model to identify strong growth names, but that also have consistent dividend components. So the combination of growth and income. If you subscribe to the service, you get a running list and a current list at any point of the names that they select to be a part of that growth and income list, that watch list. And you get great updates and reports and webcasts and such as they apply their methodology and identify those next names. You can get 10% off at marketmisbehavior.com/growth income. And I would encourage you to check it out. Thanks again to my friends at Seeking Alpha for being long-term supporters of Market Misbehavior. Next question, Dave, you pointed out how GLD broke out of a 2-month base. However, there are 5 months of overhead resistance. Doesn't GLD need a lot more base building before a substantial uptrend can take place? I had a number of questions about the chart of the GLD. That struck a chord with many, I think. And maybe just because I've been talking about this rotation. And so the moment I started talking about this as being a new accumulation phase, a number of you kind of raised your hand in different ways and said, how do we know this is really a sustainable breakout? It's not much of a move yet, et cetera, et cetera, et cetera. So how to make sense of this? So, and actually in your question, you mentioned the legendary technical analyst, Bob Farrell, who ran the team at Merrill Lynch for many, many years. And he talked about like the height of the consolidation is the breakout you're kind of projecting, right? So if you have a consolidation base and then you break out, you should take the height of the base to project the breakout level. So what one of you mentioned, I forget if it was you actually that asked this question, but what you kind of mentioned was, look, here's this little consolidation phase that you mentioned. And if that's the height of the base, the breakout, we've already reached that sort of minimum objective, right? That sort of a upside objective based on the height of the pattern. So it's like, is that it? And so I guess here's the way I would think about it. I mean, there's number one, there's different time frames, right? So I would say, if you look at the weekly chart of gold, maybe we're not quite breaking out enough yet, right? I mean, we were in a clear uptrend all through 2024 and 2025. We clearly went into a pretty significant downtrend, and we could see the sell signal from the weekly MACD. This is actually the weekly PPO that I'm using, particularly on the weekly chart. I love using bullish crossovers on the weekly PPO, particularly when it's below zero, as a sign that a new uptrend phase is working. It doesn't always work out well. Like 2021, it gave a bullish signal that fizzled out after about 6 weeks, but more often than not, that's been pretty good. And we're kind of right. I mean, we're almost exactly there. We're not quite at a buy signal, but very, very close of breaking above that signal line. So, on the longer term time frame, maybe it's still to be determined. But for me, right, I always think on kind of my primary time frame, which is kind of usually looking out about 1 to 3 months. And I would say what impresses me about the chart of gold, and the reason why I added to my position in GLD and IAU because of this breakout, was the fact that I identified this trend line, which has been, basically the January, sort of early March, mid March, April, May, June. I mean, a bunch of these peaks all kind of line up right around the same place. And so for me, once you identify kind of a key trend line like that, that's a really good visual representation of the trend. The price was below the 50-day, which was sloping downward, and most of the time below the 21-day exponential moving average, which was also sloping downwards. Then we had this bullish momentum divergence in June, which for me implies probably downside trend exhaustion. Then we have, instead of making lower lows, we're making stable lows. So all of that implies to me we're probably like near the end of that downtrend and probably in a bit of a bottoming pattern. But then the breakout above those moving averages, which are now starting to turn higher, the fact that the RSI pushes above 50, pushes above 60, for me, that's like enough of an upward surge that I think, wow, I'm going to take a shot on this being a beautiful recovery for gold. Now, from here, I would say it's all about those confirmations. It's all about what signals, what patterns would help confirm that this is a new accumulation phase and not just a bounce before the next leg higher, but before the next leg lower. So I would say, top of my mind would be the 200-day moving average, which on the GLD is around 412. So we're pretty close to getting up to that level, pretty close to breaking above that level. I think that'd be pretty important. And I would say from here, it's more about validating the uptrend. Does the 50-day moving average start to slope higher? That would help the case. And so I would say the argument kind of builds. But the way that I think about it with a trade like this is I see the initial signal, I take an initial position, or in this case, I'm sort of underweight gold. And so I, sort of added to that underweight position. And if the uptrend is validated, I probably add more to it as we check off further boxes of there. So what could, would it be a more ideal situation if it was a broader base? Yeah. And that was actually an Alan Shaw thing. Talk about another legendary technical analyst. He would say, the broader the base, the higher in space. So the longer that you have a big basing pattern, like the 6-month pattern on the GLD mid 2025, that breakout even more powerful because we'd been basing for so long. So would this be a more ideal setup if it had been in a basing pattern for a couple more months? Yeah, for sure. But investing is not always about having that perfect scenario play out on the charts. At the end, it's about the weight of the evidence. And so for me, the weight of the evidence was I'm going to take a shot at the chart. That's why I did it. So there you go. Those are some thoughts on the GLD, and I appreciate you asking about the time of that basing pattern. I think that's actually a really good point. All right, final question for today, then we'll call it a weekend. I'm interested in learning about your CMT journey. I'm looking into the program, but frustrated with limited options with review courses. Curious, what approach did you take to earn the designation? Fantastic question. So I'm a big fan of the CMT exams and the CMT Association. I'm super biased because I'm a former president of the organization and currently am working with the team to help relaunch local U.S. communities for the CMT Association. If you're not familiar with the CMT, it's a chartered market technician. It is a professional designation for technical analysts, sort of like a CFA, which is for fundamental analysis. The CMT is for technical analysis. It is really, again, it's not intended as much for individual investors at all. It's really intended for professional market professionals, for investment professionals. So there's a work requirement. You have to demonstrate that you've been in a capacity where you're making investment decisions using technical analysis as part of the process of becoming a full member and earning your CMT designation. But you're asking about the exam processes. Yeah, it is designed as a self-study course. Back in the day when I took it 20 ish years ago. And when I like mid 2000s, and when I took it, there were books. You had to buy books like the Connie Brown book and the John Murphy book and a Martin Pring book and um, uh, Perry Kaufman book. There's a bunch of different books you had to buy through the three exams. I found it to be a fabulous experience. And I'll tell you why, because it's a very practical exam. And I would say, even at this point, it still is. It's a very practical exam. I would read the books, I would analyze charts, and then I would immediately start to be able to understand the markets a little better. And it really helped me improve my decision making using technical analysis almost immediately. And the more I studied, I feel like the better I kind of had a sense of things. And then as I got through the third level, which is where you're really applying technical analysis more at the portfolio level and more about risk management, that really opened my eyes to, oh, this isn't just about analyzing, the chart of Sirius satellite radio. It's more about which chart should I put in a portfolio and how would I weight it and how do I think about sector rotation and intermarket analysis. And it just opened up my eyes to just a whole way of thinking. And I would say the other big benefit was a structured approach to technical analysis. A lot of the things I teach now about having processes and having routines and having a checklist probably were inspired in many ways by my CMT journey and learning how to make decisions analyzing the charts. Having said that, there are some like review courses and services. Optima is the one that comes to mind that I know of. That's Matthew Verdow. Has done a really good job providing CMT courses, so to kind of help you do it. And if I can find a good link to share with you, I'll definitely do that in the description. But if you look at Optima CMT training, I'm sure you'll find it. But it really is. I mean, in a lot of ways, it's not the CFA, which is a much bigger and much more established exam. There are a lot of, I remember taking like the Schweitzer class for CFA 1 years ago, many years ago. So I know those kind of things have been out there. But for the CMT, many, much less fewer, and much fewer because it's really designed as a self-study course. And I would say the other thing is the required readings also are totally different. Now it's like, it is official CMT readings that are, curating a lot of content that's written just for the exam. That's very, very good. And so I would say the quality of the materials has gone up significantly since I took it. And it's much more geared toward the exam and the questions that they're trying to ask. So it is a self-study course. I would encourage you to check out Optima's review courses, and there may be others I just don't know about. But that's what I would think about. And I would encourage you, if you are a market professional, the CMT exams, and definitely the CMT Association, a great way to meet others in the industry, looking at charts. Folks, that'll do it. Thank you so much. And again, I'm off on holiday. I'm recording this ahead of time, but I thought it would be great to just give you some Q&A to go into the weekend. Hope you had a great week. Hope the market's hanging in there okay. If we did close above 8,000, I'll be sure to work up some sort of trumpet fanfare for when I get back. But in the meantime, have a joyful, restful weekend. Thanks so much for watching. Thanks for following my work here at Market Misbehavior. We'll be back live soon. But in the meantime, I'm reminding you, it's always a good time to own good charts. Take care, folks.